Okay, so we're at this really interesting point in crypto right now. You've got all these specialized blockchains popping up, doing really cool different things, pushing
Yeah,
boundaries
it's definitely a burst of innovation.
for sure. But, this boom in chains has this big side effect. Liquidity is getting, well, super fragmented and inefficient. It's kind of like trying to run an economy where all the oil wells are totally disconnected.
Yeah.
The fuel just can't flow smoothly.
That's a really good analogy. We have this explosion of networks, dApps, everything. But the thing that makes it all work smoothly, the liquid markets, it's just not moving freely. It's sort of trapped in these little pockets.
Exactly. And that's what we're diving deep into today. StakeStone. They're building this thing they call a decentralized, adaptive, omnichain liquidity infrastructure. Sounds complex. Our mission today is really to figure out what that actually means. How is StakeStone trying to fix this liquidity mess and connect everything up better for all these blockchains?
Yeah, so we're mostly looking at their white paper. It really lays out the plan, the architecture, how the token works, the tools they're building. It's pretty detailed.
Right.
Our goal here is to just pull out the really important bits,
Yeah.
the stuff that gives you a clear idea of how it works and what it might mean, without getting totally swamped in technical jargon.
Perfect. We want to give you that shortcut to understanding what really matters, especially if you're trying to keep up with DeFi, but just don't have time to read every single white paper.
Yeah.
Okay, so let's unpack this problem first. Fragmented liquidity. It sounds like it causes some real headaches.
Oh, it's more than just a headache. It's like a fundamental drag on the whole system right now.
Yeah.
Imagine trying to trade stocks if every broker was on its own separate little island network. That's kind of what crypto feels like sometimes. Liquidity, just being able to buy or sell easily without crashing the price, it's stuck on individual chains.
And the white paper points out specific problems, right? Start it with people holding Ethereum. What's the issue they're facing?
Well, for ETH holders, especially after the Shanghai upgrade made staking easier, there's this tricky choice. Do you stake your ETH, help secure the network, get those rewards, or do you jump into all the DeFi action? Liquid staking tokens try to solve this, but they come with their own baggage.
Like what? I know some of those liquid staking tokens can be a bit finicky.
Exactly. A lot of them use rebasing the number of tokens in your wallet literally changes. Which, okay, reflects rewards, but it can be a nightmare for using them in other DeFi apps or even just figuring out taxes. Plus, most of these LSTs live mainly on Ethereum itself. If you want to use that staked ETH value on, say, Arbitrum or Polygon,
You're back to bridging.
you're back to bridging. And bridges have risks. They take time. They cost money. It's inefficient.
Okay, so that's ETH. But the white paper says it's even tougher for Bitcoin because it doesn't have smart contracts baked in.
Absolutely. Bitcoin's design, brilliant as it is, wasn't built for complex DeFi stuff. So we got wrapped Bitcoin, like WBTC on Ethereum, BTCB on BNB chain. But this just created more fragmentation. Now you have all these different versions of wrapped BTC, each in its own little liquidity puddle. Makes it really hard to keep prices consistent, manage collateral across chains.
Yeah.
It's like different dialects, Makes communication tough.
So wait, the solution wrap Bitcoin actually kind of made the underlying liquidity problem worse in some ways.
In terms of having one big unified pool of Bitcoin liquidity for DeFi, yeah, you could argue that. Billions in Bitcoin value is just sitting there, not really participating efficiently in all the DeFi innovation happening elsewhere. Huge missed opportunity.
And it's not just ETH and BTC, is it? These newer blockchains must be feeling this liquidity squeeze even more acutely.
Oh, definitely. They have the steepest hill to climb. They might have amazing tech, great ideas, but getting enough liquidity to make their ecosystem actually usable, that's incredibly hard. So what do?
Throw tokens at people.
Pretty much. They often use these unsustainable incentive models. Hey, bring your assets here. We'll give you loads of our new token. It works for a bit, maybe, but it often just floods the market with their token, crushes the price long term, and the liquidity vanishes as soon as the free tokens dry up.
Yeah, it feels like trying to fill a leaky bucket. The incentives bring water in, but if the bucket itself isn't solid or it's too hard to pour water in or out, it just leaks away again.
Exactly. And the existing bridges and cross-chain stuff don't help much. They can be slow. You need complicated oracles for price feeds. The liquidity pools are fragmented, so you get bad prices slippage when you trade. It's just messy.
So billions trapped, missed yield, major hassle-moving assets. The white paper tries to quantify this, right? How big is this problem, really?
It's tough to put an exact number on it. The market moves so fast. But yeah, the paper makes the point that if you add up all the value locked in staking in isolated DeFi apps across all these chains. It's easily billions, probably tens or hundreds of billions of dollars, that isn't working as efficiently as it could be. A huge chunk of the total value lock, the TVL you hear about, is basically stuck.
Right. And all those technical hurdles, no standard way for chains to talk, prices are all over the place because liquidity is thin, no single system to manage it all. It all adds up to this massive inefficiency.
Precisely. It's a tangle of problems, all rooted in how hard it is to move value safely and smoothly between these separate blockchain worlds.
The white paper has a visual for this, right? Traditional liquidity solutions cause fragmentation and inefficiency. What does that look like? Can you paint a picture?
Yeah, imagine like 3 separate circles, chain A, chain B, chain C. Inside each circle, you see little isolated pools of money, separate puddles. Now, say you have some asset XYZ on chain A, you want it on chain B. The old way is a bridge, shown as an arrow. But when XYZ gets to chain B via the bridge, it might not be useful right away. You might have to swap it again, maybe for chain B's main token, using another one of those isolated puddles on chain B.
So it's not just one hop, it's potentially multiple swaps through different disconnected pools, each costing time and fees.
Exactly. The picture really stresses how fragmented the liquidity is on each chain, the bad pricing you might get, and how clunky the whole process is waiting for the bridge, multiple steps. It shows these old solutions are just focused on one chain at a time.
And can you just walk us through the actual steps? Like, if I want to move my assets right now, what do I actually have to do? It sounds painful.
It often is. Okay, so first, on your starting chain, chain A, find a DX, a decentralized exchange with enough liquidity for your asset. Swap it maybe, pay gas fees, maybe get some slippage price isn't what you expected. Then, find a bridge. Research which one supports your asset and your destination, chain B. Connect your wallet. Maybe you even need another swap to get the asset in the right format for the bridge. Initiate the bridge transaction. Wait.
How long?
Could be minutes, could be hours, depends on the chains. Wait for confirmations on both sides. Then finally, your asset arrives on chain B, but it's often a wrapped version.
Still not done.
Probably not.
Yeah.
To actually use it in an app on chain B, you likely need another swap on a chain B DEX to get the final asset you need. Pay more gas, maybe more slippage.
Wow. Okay, that's a lot of steps, a lot of fees adding up, and a lot of time where prices could just go wild.
Exactly. High costs, delays, price uncertainty, that's the reality of fragmented liquidity. And that's the core problem StakeStone is trying to solve.
Okay, so StakeStone calls itself a foundational infrastructure layer for efficient liquidity distribution across all blockchains. Big claim. How are they actually planning to do that? What's the big idea?
Their main idea is to get past these clunky old bridges. They want to build a more connected system where liquidity is generated more, well, organically. They've got this whole suite of solutions. Stone, which is their fancy yield-bearing ETH, then SBTC and STONEBTC for Bitcoin, making it omnichain and yield-generating, and something called LiquidityPad for new ecosystems.
Let's start with Stone, yield-bearing liquid ETH. That sounds like it tackles that ETH staker problem directly. How is it different from other liquid staking tokens already out there?
What the white paper really highlights is Stone's design. They call it adaptive staking, dynamic yield optimization. The key thing seems to be its modular architecture. They separate the actual creation, the minting of the Stone token, from the strategies that generate the yield.
Okay. Why is that important?
It makes the whole system more flexible and stable. They can swap different yield strategies in and out behind the scenes, like using LiDo or EigenLayer or their own stuff without messing with the Stone token itself. Stone stays consistent, but how it earns yield can change and get optimized.
Huh. That's pretty smart. Like the currency stays stable, but the investment portfolio backing it can be actively managed. So break down these parts they mentioned. StakeStone Vault, Minter, Strategy Pool, and OPEP.
Sure. So the StakeStone Vault is like a secure waiting room. You deposit your ETH, it goes into the vault first, acts as a buffer, helps manage gas costs, makes things efficient before the ETH gets sent off to earn yield.
Got it.
Then the Minter, this is totally separate. Its only job is to issue Stone when ETH comes in and burn Stone when it's redeemed for ETH. Keeping it separate means Stone's price and supply aren't directly jolted around if one yield strategy has a hiccup.
Okay, that separation makes sense. Keeps the token stable. What about the strategy pool? That's where the magic happens.
That's where the yield gets generated, yeah. The deposited ETH goes into this strategy pool. It's not just one thing. It's a mix of different strategies, like staking with LiquidityPad, maybe restaking with EigenLayer, using their own lending pools or market-making network. And importantly, each strategy is kind of isolated within the pool, which helps manage risk. If one strategy underperforms, it doesn't necessarily sink the whole ship.
And OPAP, On-Chain Proposal Allocation Protocol. That sounds like the brains of the operation, deciding where the ETH goes.
Exactly. OPAP is the decentralized governance part. It uses their governance token, STO. Holders of STO vote through OPAP to decide how much ETH goes to each strategy in the pool. The goal is to constantly chase the best competitive yield for Stone holders while keeping Stone itself stable and liquid. Think of it like an automated investment committee run by the community.
There's a visual for this too, isn't there, for Stone?
Yep. Stone, the yield-bearing liquid ETH. It shows ETH going into the vault, then flowing to the strategy pool with branches out to LiquidityPad, EigenLayer, their native lending stuff. This pool feeds the minter, which issues Stone to you.
Okay.
Then it shows Stone being used in StoneFi pools, DEX pairs, lending, derivatives, earning extra StakeStone rewards. And crucially, it shows omnichain redemption, getting ETH back out easily, and instant swaps of Stone across different chains, A, B, C, plus their market maker rebalancing things everywhere.
So it's like this whole loop: generate yield, keep Stone liquid everywhere, make it easy for ETH holders. That omnichain redemption and instant swap sounds key to fixing that fragmentation problem we started with.
Absolutely central. The whole point is to aggregate ETH liquidity, make it chain agnostic, cut down that fragmentation, and reduce the friction and costs for users who want to use their staked ETH across different DeFi platforms.
Now, you mentioned StakeStone focuses on organic liquidity generation, not just those maybe unsustainable token giveaways.
Yeah.
How does their on-chain liquidity infrastructure actually do that?
Right. This is where Native's credit margin engine, or CME, comes in. The whitepaper calls it the core market-making system for this seamless omnichain liquidity. Instead of just paying people with new tokens to provide liquidity, they actually use some of the ETH that people deposit to mint Stone in the first place.
How?
A portion of that deposited ETH automatically goes into Native's on-chain lending pools.
Ah, okay. So the ETH people stake to earn yield also becomes the fuel for the cross-chain liquidity. That's clever. Bootstrapping liquidity without just printing tokens.
Exactly. The CME uses these lending pools along with Native's PM, their professional market maker network, and clever automated algorithms to handle cross-chain settlements. This setup aims for better price discovery, deeper liquidity across all connected chains, and less slippage for users when they trade or move assets.
So it's not just a passive bridge. It's actively creating and managing this underlying liquidity pool that works across different networks more efficiently.
That's the idea. Native system also has this chain-agnostic aggregation layer and a compatibility engine, basically standardizing how different chains tap into this shared liquidity. The white paper talks about a self-reinforcing flywheel. More ETH deposits for Stone yield, stronger omnichain infrastructure, attracts more users looking for easy cross-chain moves, more deposits, and so on.
And the image, StoneX native PMM network, shows this.
Yeah, it visually pulls it together. You see ETH or Stone flowing in from different chains A, B, C, X into the central StoneX native PMM network. Inside, it depicts concentrated liquidity for ETH and Stone. It highlights benefits like potentially much higher capital efficiency, better price discovery, one-click cross-chain transactions, and wide omnichain access. It really drives home how assets from different places can merge into one efficient pool.
That definitely sounds like a leap forward from those multi-step bridge nightmares. Okay, let's switch to Bitcoin. SBTC and STONEBTC. Bitcoin doesn't do smart contracts easily. How does StakeStone pull it into this omnichain world?
Right, that's always been the challenge for Bitcoin and DeFi. StakeStone's answer starts with SBTC Omnichain LiquidityPad. The goal here is to take all those different fragmented wrapped Bitcoins, we talked about WBTC, BTCB, etc., and consolidate their liquidity into one single unified asset, SBTC, that can move easily across chains.
Like a universal Bitcoin translator for DeFi. How does that work technically?
They use a system of vaults and minters, similar to Stone but for BTC derivatives. So on BNB chain, you could deposit BTCB into an SBTC vault, and the minter gives you SBTC. On Ethereum, you deposit maybe CBBTC or FBTC into a different SBTC vault, use its minter, and again, you get SBTC.
Okay.
An omnichain bridge layer connects these pathways, making sure SBTC keeps its value consistent and accessible everywhere it's supported. The white paper mentions SBTC is mainly backed by BTCB right now, as a diversified basket.
The expanding image shows this, right?
Yeah. Exactly. It shows separate paths for BNB chain, BTCB, Vault Minterm SBTC, and Ethereum, CBTPT of BTC, Vault Minterm SBTC. Both paths clearly state instant 1.1 withdrawal. Critically, there's an omnichain bridge connecting them, an arrow showing SBTC expanding out to other chains like Mantle, Linea, Zircuit, suggesting it's designed to grow.
So SBTC aims to be the standard liquid Bitcoin across chains, and you can always swap it back 1.1 for the underlying derivative you put in. That could really simplify using Bitcoin cross-chain.
That's the goal. Consolidate that fragmented liquidity, improve capital efficiency, make it way easier to use Bitcoin in lending, DXs as collateral, all that DeFi stuff.
And then there's StoneBTC, the yield-bearing version. How does that fit in?
StoneBTC builds on SBTC. It takes that unified liquid SBTC and plugs it into yield strategies. These could be in DeFi, CeDeFi, that mix of centralized and decentralized finance, maybe even real-world assets, RWAs. If you have SBTC or even other approved liquid Bitcoin tokens, you deposit them, they automatically convert to StoneBTC and start earning yield right away from different strategy vaults.
So unified liquidity with SBTC, then add yield with StoneBTC. Can you still get your Bitcoin back easily?
They leverage that omnichain setup for efficiency. While yield strategies might have some locking internally, the white paper mentions a maximum withdrawal time of just 7 days for StoneBTC back to the underlying. That's pretty good compared to typical staking. And StoneBTC is still usable in DeFi while it earns yield.
Okay, so SBTC and StoneBTC together sound like they could finally bring a lot of that parked Bitcoin capital into DeFi much more effectively.
That's the vision, yeah. Unified liquidity plus automated yield for Bitcoin across many chains. Tackling those historical BTC and DeFi problems head-on to hopefully build a much bigger BTC-Fi space.
All right, let's look at LiquidityPad. This one's for the new emerging blockchains. What's the specific problem it's solving for them?
We talk about how hard it is for new chains to get that initial liquidity bootstrap. LiquidityPad is specifically designed for that. It's a platform to issue tailored omnichain liquidity for these diverse, specialized networks. Think of it like a dedicated two-way bridge connecting Ethereum's mature, capital-rich ecosystem with these up-and-coming chains.
So helping new chains tap into Ethereum's money pool. How does it work?
Users on Ethereum can deposit established assets, ETH, WBTC, stablecoins, etc., into specific vaults on LiquidityPad, each vault dedicated to a particular emerging ecosystem. When they do this, they get back LP tokens. The key is, these LP tokens are designed to be useful both in the new ecosystem and back on Ethereum.
Okay. So the LP token itself acts as the value bridge, usable in both worlds. That sounds neat. What's the win-win here?
For the new chains, they get vital liquidity without just relying on short-term token incentives. For the Ethereum users, they get a chance to earn potentially higher yields from these new ecosystems and participate in their growth. Plus, the LP tokens they get aren't useless back on Ethereum. They can still be used in Ethereum DeFi. The white paper calls it an economic flywheel.
Flywheel, how?
Capital flows from Ethereum to the new chains chasing yield and growth. The alpha, the early gains or higher returns from those chains, flows back to Ethereum through the utility of these cross-ecosystem LP tokens.
And LiquidityPad, the essential pipeline image, illustrates this.
Yeah, pretty clearly. It shows the Ethereum ecosystem, big, capital, mature DeFi, compatible LP tokens on one side. Users deposit assets into LiquidityPad vaults for different emerging blockchain ecosystems, labeled A, B, C, X. These emerging chains are shown as specialized, high-yield potential, but needing liquidity. The big visual is the LP tokens flowing back to Ethereum, bridging that alpha and yield. It also mentions potential extra rewards or airdrops from the ecosystems. The key ideas highlighted are omnichain liquidity, tailored strategies, and that two-way flow.
So LiquidityPad is about creating a sustainable economic link, not just moving assets around. Could be a real growth engine for the whole space.
That's the potential, yeah. Helping new chains grow more organically by providing efficient, tailored liquidity.
Now let's talk about the token that makes this all tick. CT dollars, governance, tokenomics. How does STO fit into this whole StakeStone picture?
STO is really the heart of it. It's the governance token that coordinates how value moves around this whole omnichain system. It also gives the community control over the protocol's future. The whole model is designed to get everyone, liquidity providers, other protocols, users working together for long-term growth.
They use a vote-escrowed model, veSTO. What does that mean for someone holding STO?
Right. You lock up your STO tokens, and in return, you get veSTO. The longer you lock, the more veSTO voting power you get. Holding veSTO doesn't just give you votes, though. It also unlocks benefits like boosted yields if you're providing liquidity in their system.
Okay.
You can convert STO to veSTO easily, but getting liquid STO back usually involves a waiting period, like 30 days mentioned in the paper. This encourages people to stick around and participate long term.
So veSTO gives you a vote and boosts your earnings. What exactly do veSTO holders vote on?
Two main things. First, deciding where the STO token rewards go. These rewards incentivize liquidity in the different StoneFi pools, BTCFi pools, and the LiquidityPad vaults. veSTO holders vote to direct these incentives. By doing so, they also earn a share of rewards from the pools they vote for, including more veSTO and potentially a cut of any bribes.
Bribes. Okay, that sounds interesting. What are bribes in this DeFi context? Not actual under-the-table stuff, right?
No, not like that. It's a pretty standard term in DeFi governance now. Basically, other protocols might want more liquidity directed to their pool within StakeStone. So they offer an incentive, maybe their own token, maybe stablecoins, to veSTO holders who vote to send more STO rewards to that specific pool.
Ah,
It's a way for projects to compete for liquidity using incentives. StakeStone's model mentions that a portion of any STO used as a bribe gets burned, which reduces the STO supply. The rest goes to the veSTO voters. And the treasury can also accept partner tokens as bribes, which benefits voters too.
got it. So it's an open incentive mechanism to guide liquidity. What's the second main thing veSTO holders influence?
Yield boosts. If you provide liquidity and you hold locked veSTO, you can get higher yields. The more veSTO you have locked relative to your liquidity, the bigger the boost. It's another strong reason for users to not just use the platform, but also lock STO and participate in governance.
Okay, so how does the STO token itself actually capture value from all this activity? Where does the value come from?
Several ways. First, platform fees. When people withdraw assets from StoneFi, BTCFi, or LiquidityPad, StakeStone collects fees in things like ETH, BTC, stables. These go to the treasury, representing direct platform revenue.
Makes sense.
Second, the bribe system we just talked about. When STO is used as a bribe, some gets burned, making STO potentially deflationary. And the treasury collects partner tokens offered as bribes, diversifying its holdings.
And there was a swap and burn mechanism, too. How does that work?
Yeah, this one's interesting. It gives STO holders a way to swap their STO for other assets held in the treasury, like blue chip crypto or partner tokens, if there's an arbitrage opportunity on DEXs. Say a token in the treasury is cheaper there than on an external DEX. veSTO holders could swap STO for it, sell it on the DEX for a profit. This swap uses STO, potentially burning it or removing it from circulation, adding more deflationary pressure, and giving holders another way to realize value.
So STO really is central. Governance, incentives, value capture, even market mechanics. It ties the whole ecosystem together.
Exactly. It's designed to create this feedback loop where platform success benefits STO holders, who are then incentivized to govern well and help it grow.
Lastly then, looking bigger picture, what's StakeStone's ultimate vision? Where do they see themselves in the future of blockchain?
It's definitely ambitious. They see this moment with all the specialized chains as a key turning point, lots of innovation, but also this big liquidity fragmentation problem. StakeStone wants to be the fundamental infrastructure layer that solves this. They want to enable truly seamless omnichain liquidity.
They make a comparison to TCP/IP for the internet, right? Like the basic plumbing that lets everything connect and communicate.
Yeah, it's a bold comparison, but it captures their goal. To build that foundational layer where liquidity flows as easily across blockchains as data flows across the internet, they imagine a future where chains can just focus on innovating, not constantly fighting for liquidity using inefficient methods.
So moving beyond just connecting chains to enabling this really smooth, efficient flow of capital everywhere in the decentralized world.
Precisely. And they stress things like transparency, efficiency, and sustainability are key to getting there, becoming the go-to omni-chain liquidity infrastructure.
Okay, let's wrap this up. Key takeaways for everyone listening from our deep dive into StakeStone.
I think the main thing is that StakeStone is tackling that huge liquidity fragmentation problem head-on with a pretty sophisticated set of tools. Their whole omnichain infrastructure, Stone for ETH, SBTC, STONEBTC for Bitcoin, LiquidityPad for new chains, aims for more efficient, organic, and sustainable liquidity flow than just using bridges. And their STO tokenomics are really designed to tie it all together, incentivize participation, and align everyone long-term.
And the potential impact if they pull this off.
It could mean a much more connected, much more efficient DeFi world overall. Breaking down those liquidity silos could unlock a ton of trapped value, making it cheaper and easier to move capital around. This could really pave the way for new kinds of financial applications that just weren't practical before because of all that friction.
Right. So something for you to think about. What happens if liquidity really becomes seamless and chain agnostic, if capital can flow across all these blockchains as easily as information flows online? What new things become possible? It's a pretty fascinating thought. If you want to go deeper, definitely check out the StakeStone white paper and their other resources. Thanks for joining us on this deep dive.